Hey everyone, and welcome. Today we're going to tear down a fintech company called Pioneer. Now, on the surface, it looks like a pretty simple tool for freelancers and small businesses to get paid from all over the world. But trust me, its real power, its secret weapon, is a hidden profit engine that's turning customer funds into hundreds of millions of dollars in pure interest. It's pretty wild.
And that really brings us to the big question for this whole explainer. How do these giant global payment companies actually make their money? You probably think the answer is simple, right? But as we're about to find out, the obvious answer is definitely not the whole story.
Okay, let's just break this down. You've got two main ways these companies bring in cash. On one side, you have the obvious way, transaction fees, right? Every time you send or receive money, they take a little slice. Super straightforward. But then you have the secret way, the one that provides this huge, stable foundation of profit, interest income. And believe me, this is where Pioneer's story gets really interesting. But before we unpack that monster profit engine, we really need to get a handle on what Pioneer's core business actually is. So let's start there. So, at its heart, Payoneer is a global payments platform. It's built for small and medium-sized businesses and freelancers, especially those in emerging markets. Think of it like a financial bridge connecting a merchant in, say, Southeast Asia, directly to huge marketplaces like Amazon or Upwork. And this means its money comes from two places, those standard transaction fees and that all-important interest income we keep talking about. All right, you ready? Now for the main event. Let's pull back the curtain and really look at what makes Pioneer's business model so powerful and, honestly, so resilient. We're talking about its surprising profit engine, the hidden power of just holding on to its customers' funds. Okay, the scale here is just staggering. At any given moment, Pioneer is holding around $7 billion in customer funds. Now, let's be super clear here. This is not Pioneer's money. It's capital from their users just sitting there in the system before it gets paid out or withdrawn. And this giant pile of cash brings us to a really important financial concept called float, which is what generates that interest income. It's the profit a company can make just by earning interest on customer money it's holding temporarily. So by having access to that $7 billion, Payoneer basically gets to act like a bank, investing that cash in super safe interest-bearing assets. So, what does earning interest on $7 billion actually look like in real numbers? Well, for 2025, Pioneer is projecting it will earn somewhere between $225 and $250 million from this interest alone. That is a massive, incredibly stable revenue stream that has literally nothing to do with how many transactions are happening. It's a financial bedrock for the entire company. Okay, so this financial strength sounds great in theory, but how does it actually show up in the company's results? Does this interest income translate to real-world performance? Let's follow the money trail and have a look at the numbers. This chart right here tells a really powerful story. The overall revenue grew a very healthy 9% year over year. Not bad at all. But then, look at the B2B segment, the business-to-business part. It exploded by 37%. This shows you that the real engine here isn't just getting more users, it's getting higher quality business clients who are deeply plugged into the platform. And this just hammers that point home. The average revenue per user, what they call ARPU, has almost doubled in just 2 years. This is such a clear sign the Pioneer isn't just signing up more random users, it's getting way better at attracting more valuable, more integrated business customers who are running more and more of their financial operations through the platform. And you know what? Management is putting its money where its mouth is. The company recently announced a $300 million share buyback program. This is a classic signal of confidence. It's basically them telling the market, hey, we believe our company is financially strong and we think our stock is a bargain right now. So this all sounds amazing, but the big question is, can they keep it up? Is it sustainable? What's stopping a competitor from just coming along and doing the exact same thing? Well, this brings us to Pioneer's competitive advantage, or what investors like to call a business moat. So, their main defense is a really powerful network effect. Here's how it works. First, a small business joins so it can get paid internationally. Simple enough. Second, they instantly get plugged into this huge network of over 7,000 payment corridors. Those are the financial highways between different countries. And third, as more businesses and marketplaces join, the whole platform just becomes indispensable. It creates this virtuous cycle that is incredibly hard for any competitor to break. And on top of that network effect, you have really high switching costs. Once a business builds its entire payment system around Pioneer, trying to change platforms is super complex and risky. It's like trying to change the foundation of your house while you're still living in it. You add competitive pricing and some very sophisticated AI for fraud detection, and you end up with a very, very sticky product. And in global finance, trust is everything.
So, okay, we've got a strong business model, a killer hidden profit engine, and a durable moat. But what does all of this actually mean for investors? Let's dive into the numbers and see if the stock might actually be undervalued. Looking at the valuation here, a couple of things really jump out. A price-to-earnings ratio of around 24, that's pretty low for a profitable, growing fintech company. The stock is also trading right near its 52-week support level, which suggests there's probably not a lot of downside risk. You combine that with an average analyst price target of around $9.75, and you're looking at a potential upside of nearly 60%. This quote just perfectly captures the whole argument here. Payoneer isn't just a payment processor anymore. It is becoming the cross-border bank for entrepreneurs in the digital age. It's providing that essential financial plumbing that global businesses need to succeed. So, what's the final takeaway from all this analysis? Well, in the short term, the outlook seems to be to hold or accumulate shares. The downside risk looks low, and the upcoming earnings report could be a nice catalyst. But for the long term, the verdict is a buy. The combination of that strong moat and its key position in the high-growth B2B market makes for a really compelling case. And that really leaves us with one final, kind of provocative thought. For the most part, the market still looks at Payoneer and sees a simple payments processor, one that's tied to the ups and downs of transaction volumes. But after seeing how they leverage billions in customer funds to generate stable, bank-like profits, I have to ask, do you see something different?